Hey, welcome everyone. We'll get started in a couple minutes here. Julia, yes, this will be recorded, and yeah, looking forward to getting started shortly. Just as we're kicking off here, wanted to kind of share. This is part of our Prepare for VC event series in partnership with Boston New Technology as well, and the Startup Grind Boston group. So basically, Prepare for VC has a variety of cohort, community, and consulting opportunities to help startups scale and grow their businesses. We actually have a big event series coming next week as well, in person for anybody that'll be in the Boston area. It's called our Startup Spring, and that's actually going to feature everything from our Prepare for VC demo day for our startup companies that are graduating our accelerator cohort on Wednesday, to a variety of events throughout the week with different workshops and opportunities for the startup community surrounding the TechCrunch early stage conference that's happening next Thursday. So yeah, just put a link in the chat to check out the Startup Spring event. And yeah, excited to see Will and Jeff up with us. They've all done a great job. This is our second webinar with them, and they've both also led sessions within our accelerator cohort. So always a great experience learning from them and having them share their knowledge with the community here as well.
Thanks, Jason. Thanks for having us again.
Yeah, of course.
Looking forward to it.
Yeah, excited to have you.
Sweet.
And yeah, so yeah, we actually invite. So here we go. Let me. Oh, wait, I didn't save. Yeah, so we invited, or we have some new faces joining us, some new audience members, and we had invited everybody that came out to the last session you guys did to join us as well. And yeah, really excited to have you guys, kick us off and share what we should be learning about SAFEs, convertible notes, and price rounds. And yeah, we can keep this interactive as well with any questions in the chat coming through. I'll be there to monitor them along the way. And yeah, feel free to everyone introduce themselves and share a little bit about what you're working on in the chat as well. But yeah, with that, happy to turn it over to Will and Jeff, and you can both use the arrows at the bottom to kind of scroll and move forward along the way.
Awesome.
Perfect.
Thanks, Jason.
Yeah, thanks, Jason. Appreciate it, and excited to be here. Like Jason said, feel free to drop any questions into the chat. Jason, we can make this super conversational and beneficial. So feel free to interrupt Will, myself, if we miss questions, and just pipe in interject, if you will.
Yeah, we'll be watching it as we go through we'll be watching the chat as we go through the deck too. So everybody can feel free to just chime in there, and we'll get to it as soon as we see it, of course. And then we'll do some Q&A at the end too, about 10 to 15 minutes. Right on. Well, with that, I think it'd be great to get started with some introductions. So Jeff, I'll let you introduce yourself, have you introduce yourself and Forecastr. It'd be great to hear kind of some of your industry experience, why you're up here talking. So I'll kick it over to you.
All right. Sounds good, Will. So just for the background of everybody here, Will and I actually worked together at Carta. I left about a year and it's coming up on a year and a half ago, and went to a little company called Forecastr. I'll let Will tell you a little bit more about Carta, and a lot of the contents can be driven around that. But I'll tell you a little bit about Forecastr. Forecastr is similar to Carta in the sense that Carta takes the cap table data out of spreadsheets and into an easy to use software platform. Forecastr is doing something similar with the financial model. So every company is raising capital. You typically need your financial model, help you figure out, how much you're going to raise, how you're going to use that capital, make strategic decisions for your company. We're helping take that financial model out of a spreadsheet and into a software model that's easier for founders to use and, create a strategic decision-making tool for you. So we're the online financial modeling company, and we have, 600 customers now, 630, I think, that are using the platform. We're a fairly early stage company ourselves. We're raising a Series A right now. And so that's kind of where we're at Forecastr. Little background on myself. Before Forecastr and Carta, I was a founder. Started a company, ran it for about 10 years, sold it to a private equity group, and they made me stay on as the CEO for 3 years. And after that, I took a little break before I joined Carta. But I also have experience not only from the founder side, but also from the investor side, as I've been pretty active in terms of angel investing. And so can talk about some of these things that we'll talk about today from that perspective as well, as a lot of my investments have been done through SAFEs, convertible notes, and some priced rounds. So, okay, so that's enough about me. I'm going to flip things over to my good friend Will here.
Sweet. Thanks, Jeff. So I'm Will Buckstaff. I've been with Carta for almost 3 years now. I work on the business development team at Carta. And so like Jeff was saying, the kind of main thing with Carta, I'll share a little bit more about it in a second, is kind of having your cap table in a software in a cloud where it can be reconciled by investors, lawyers, company management, and all that. And so I'm on the business development team. And so we work with everybody who partners with or is really just adjacent to the ownership structure for a company. When I say that, I mean like law firms, venture capital firms, really anybody who touches the cap table that's outside of the company itself, because there's kind of, it definitely takes a village of folks to go like raise a financing round or take care of a company's ownership structure. And so my team partners with, anybody who's kind of involved in that front, including incubators or accelerators and such too. And so that's a little bit about my team and kind of myself at Carta, but just a little bit on Carta specifically. So Carta works with about 50% of VC-backed companies to help them manage their ownership structure, to help them manage their cap table. And when people say cap table, I think everyone thinks of kind of like a line by line uploading of like an Excel doc or something. But a cap table is really a reflection of all of the securities you've issued. It's really the investable story for your company. And so that's all the options that you've given to employees, any safes that have converted onto the cap table or notes, which we'll get into kind of what those both are in a little bit, but it gets complicated really quickly. And so there was definitely a market need in the early 2010s for something like Carta. So Carta definitely kind of hit it on the sweet spot then and has been running with it since. And we also do the 409A valuation work for companies, for private companies. And that's a type of kind of compliance focused valuation you need to be able to issue out options and price your common stock. So Carta is kind of the leader on that front. And then the other arm of Carta is on the investment management side of things. So working with funds to help them with fund administration, capital call lines, or some of the valuations that those entities need. And then the two kind of funds and companies are tied together with what's called Carta liquidity. So that's when late stage private companies need to do any sort of liquidity event, whether it's a tender offer or there's secondary block trades that can go through Carta. So that's kind of a high level on the full platform. And then today, the reason that kind of it makes sense for Jeff, who's had so much industry experience, and then myself, who's at Carta, I'm at Carta, to kind of talk on this subject is because we see so many of these types of instruments going through our platforms, and there's a lot of little nuances about these instruments that are critical in how your company will look ownership structure wise down the road. And there's implications at the early stages that you need to really take care of or understand so that you don't make any really big mistakes or hiccups that will impact you or dilute your company a good amount later. But that's a little bit on me. We can go to the next slide. Yeah, so I'll talk quickly. This is, of course, the legal disclaimer that Jeff and I are not lawyers. Carta and Forecastr do not practice law. But I think there's an important kind of point on this slide, which is get a really good startup attorney. So for the founders who are in this audience right now, we could say, yeah, this is not legal advice. We're kind of going to tell you what we typically see in the industry. We're going to share some data from Carta. There's a little activity at the end, kind of data-based for safes and notes, but this is not legal advice by any means. But that being said, definitely go get really good legal advice because it's really important. So I've seen a lot of people scrap together startup documents from the templated stuff online, which can work okay, but it's really important to have somebody who has a legal background that understands startup law when you're putting together a safe financing round or when you're forming your company or anything like that. It's really important to do it correctly for the tax basis that you'll have later, for the ownership percentage that you'll want to have later. And so really important, if there's anything on this legal disclaimer slide that you get out of this, it's that you should get a really good startup attorney. Jeff and I both know a ton of startup attorneys. I'm sure Jason does too. It's not that hard to find really good ones, but just make sure you do. And make sure you find a good attorney too. There's a lot of attorneys who will say they're startup lawyers who maybe their practice area of focus is somewhere completely different. I would make sure to check who they've worked with to make sure when they say they can do startup law that they've had a lot of experience with it too.
Yeah, the last thing you want is a startup attorney who has never done a Series A or a convertible note or something. So make sure you have an experienced startup attorney that you're working with. All right, so we're going to jump into things on financing instruments. And at a high level, the three instruments we're going to talk about are SAFEs, convertible notes, and priced rounds, where you're issuing preferred stock directly to investors. So just at a very high level, we'll explain a quick overview of each. A SAFE, for those of you that don't know, it's a simple agreement for future equity. It is a convertible instrument. And when we talk about convertible instruments, we're saying that they're not necessarily equity when you issue them, but the intent is to have it convert into equity at a later date. And for a SAFE, it's super simple. You're just basically saying, we'll promise, I promise to give you equity later for your investment today. And you set, some simple terms that we'll go through in detail, where it's maybe a discount or a valuation cap. And then that would convert based on those terms at a future date. Similarly, a convertible note is also a convertible instrument, suggesting that it is a debt instrument that you'd put in place that might have interest in it associated with it. But then also it has provisions, a trigger event that would say this is when it would convert to equity, and you'd have the terms that would follow with that. The main difference there is that these are converting into equity at a later date, as opposed to what you'll hear termed as a priced round. And the priced round is where you're giving equity, and defining how much equity you're giving to your investors for an investment that they're making. So you're just issuing them stock straight out of the gate. So we'll get into why you might want to do one over the other in all of these three scenarios, but that gives you a good overview of kind of the differences. Will, anything to add to that before we jump into things a little bit deeper?
Well, happy to do a quick why on each of them. Just fork out of SAFEs, notes, and preferred stock. We'll get into more of the kind of deal mechanics for each of them later. But like the SAFE, like Jeff said, with the SAFE and the convertible note, it's really straightforward at the early stage because it'll be, it's a promise of equity later. You're not actually giving them equity now, but you are taking cash now. You are infusing capital into the company that you can use for operations or hiring folks or product dev, anything like that. And so at the earliest stage, SAFEs and convertible notes are really good because they're really simple to put together. Yeah, I know it's in the word SAFE, simple agreement for future equity, but it's exactly that. There's some really straightforward templated language that typically founders will do them because they will incur a lot lower billable hours from your lawyer. And the reason is too, like if there's a really customized document that's say a super customized, even a convertible note that the lawyer has to really understand every term of, this can take them a while to go through that. And one of the biggest expenses for a financing round is typically the billable hours, right? That your lawyer is going to be billing you for, right? Like I've heard kind of the number floated around that the average Series A costs founders more than $100,000 in billable hours, right? So it can be really expensive to do that. And of course, a Series A, that would typically be the one all the way to the right, the preferred stock financing round. But at the earliest stage, the reason that SAFEs and convertible notes can be so affordable is because it's not proportionally lower to the amount that you raise, lower than a Series A. If you do like a SAFE or a convertible note for billable hours, it's going to be even lower than that because a SAFE template, like there's a couple different ones that we'll talk about. One that's really popular is what's called the Y Combinator post-money SAFE. And most lawyers who do startup work, they've seen that type of SAFE so many times before that when they hear that it's just this SAFE with these terms and kind of the other deal mechanics that we'll talk about in a second, they know exactly what it means. So they're not going to have to go redline and look through every single word in that agreement. So they'll know it. So it's going to cost a lot less in billable hours. So founders do that because it will go for SAFEs and convertible notes at the early stage for that one reason. That's one of the reasons. I'd say the other one too, which we'll get in when we talk about kind of what a valuation cap and a discount for a SAFE and a convertible note mean, is that it punts the valuation out, right? Doing a formal valuation for the company for a preferred stock financing round, which I'll kind of talk about what it means to do that. It takes a lot of due diligence and yes, a lot of billable hours. But the other thing too is when the company's really early stage and maybe there's not a ton of tangible assets or revenue or things that you typically measure more mature businesses on. It's actually sometimes a really good strategy to punt the valuation out and say, hey, we're going to take this money now and you'll get this convertible note or this SAFE, and it won't be equity. It won't be an ownership percentage in the company immediately, but because later it will convert into equity, we'll convert it into equity based on a valuation down the road. And so that's one of the mechanics too, is saying we don't need to get a formal valuation. We don't need to pay a ton in legal fees, but we can still take on capital. That's probably one of the top reasons why the SAFE and convertible note just gained so much popularity in the last 15 years too. I think Jeff hit on it. The main difference between the SAFE and the convertible note is that one's debt. The convertible note's debt. SAFE is not. I think there's a little bit more on that in a second in the next slide. But the last thing I want to share is preferred stock financing rounds. Like why they take so much due diligence is because there's a formal valuation and agreement of terms for any new investors that are coming on, and then for any existing investors who are either converting onto the cap table from a SAFE or a convertible note, or who are following on from their last round. And there are, I know I floated out that like $100,000 for like a Series A in billable hours, but of course, I'm not going to break it down fully as to why that costs so much, but you have to do a formal, what's called pro forma cap table, where typically it's going to take a lawyer 5 to 8 hours to build out this really intense spreadsheet of basically what your company looked like, the ownership looked like before your financing round, and then with the infusion of capital, what the ownership now looks like after the round. Right. There's a lot of math that goes behind that, because there's these convertibles sometimes have interesting terms of how they get onto the cap table. And then there's other investors who have certain types of rights to what's called participation or pro rata, meaning they can keep their percentage of ownership from round to round to round. And so there's a lot of calculations that go into it, and it takes a lot of math and time from lawyers who oftentimes are billing really high numbers, sometimes in the high hundreds, low thousands per hour. So that's like one element of why preferred stock financing is so expensive, that you don't need to do with a SAFE or a note. But then also there's lawyers who you'll have to generate what's called a signature packet. The National Venture Capital Association has several financing documents that have been pretty standardized across the industry for financing documents. I'm not going to go into what each of them is, but usually investors will have to go in and sign each of these documents, and then wire the money. And then there's wire tracking, signature tracking, right? So you can see how it builds up to be complicated pretty quickly, in addition to the formal valuation that you have to agree on and negotiate with the investor. That can take time as well. So that's all to say, preferred stock financings take a lot more due diligence versus the convertibles and SAFEs. All right, we can go a bit into the differences. Jeff, I'll kick it over to you for this for a bit.
Awesome. And I saw that Marsh actually has a question in here, and that's perfect segue into SAFEs and convertible notes. So Marsh's question was, what is the difference between the SAFEs and the convertible notes? So here's where we'll talk about that a little bit. With your SAFE, like Will was saying, it is super simple. You're basically identifying that at a future date, when we raise our next round of capital, and a lot of times it will say, define that round of capital. When we raise our price round at maybe $1 million or more, or whatever the term says, then this will convert into equity based on these terms. Really, the only things that you have to kind of figure out there are what is the valuation or the discount that you would have. So the discount would be if I've got a 20% discount rate on there, then if the next round was priced at $1 and I had a 20% discount, I would get to buy those shares at 80 cents. So I'm getting more shares with the $100,000 I put in or whatever than I would if I waited to invest in that price round later. So I'm getting a benefit that way. But then as an investor, you'd also probably put in something called a valuation cap. And the valuation cap is something that basically says, let's agree that the company is roughly worth about this right now. And so let's say it's an early stage and you say, okay, it's a $4 million valuation cap. Well, now if the company goes out and raises $3 million, then I'm going to have that discount still. Well, actually, then I would take the $3 million valuation. But if they raised higher than that, let's say a $10 million valuation later on down the road, as an investor, I'm getting the benefit of coming in early and saying, well, okay, instead of just getting a 20% discount, I'm now getting a much better return of being able to have the valuation set at 4 million instead of, if it was just the discount, it would have been discounted from 10 million to 8 million. So that's a benefit for me as an investor. The convertible note also has and we're going to talk, I guess, Will, you just slipped to this next slide. We can talk a little bit more about valuation caps and discount rates here. But the point I wanted to make was the SAFE and the convertible note, you can have a valuation cap and a discount in both. And so in that way, like Marsha was saying, they're very similar. The difference that we're going to have on the convertible note is that one, there is, first off, it's debt. It is a debt interest instrument where it's going to have a maturity date and typically an interest rate. So as an investor, I kind of like that a little bit better because one, I get I get a little bit of interest there, but I also have a trigger that is not just, hey, when you raise your next round. So where I'd feel more comfortable is if I'm not sure when the company or if the company is ever going to raise another round of financing, I'd probably feel a little bit more safe with a convertible note, no pun intended. So the reason for that is that, let's say I put a 12-month maturity date on my convertible note. Now I have something within that 12 months that says, or at that 12-month mark, where I could go in and say, hey, you guys haven't raised your round, it hasn't converted. I either want my investment back with the interest, or let's renegotiate something, and maybe I have a little bit more leverage there as an investor. And so that's kind of the primary difference of a convertible note. Your convertible note's going to have a couple additional terms in there that you have to potentially negotiate, but more or less, a SAFE and a convertible note, very similar. Hopefully that helps explain just the few key differences there.
Yeah, Jeff, thanks for going kind of deep into the differences. I think one thing that's interesting that I've seen, you see this statistic here that says 82% of convertibles now happen on SAFEs. So you've seen a way broader adoption of SAFEs in the last 5 or so years. Definitely a little bit more coastal focused, I would say, from the data that we've seen on who's adopted SAFEs the fastest. In San Francisco, I think it's about 90-something% of early stage rounds are done with SAFEs, versus Jeff, where you're at in Salt Lake, I bet you it's probably closer to would you say about 50-50 in the angel market that you see?
No, I think it's still you see a lot of SAFEs.
Still a lot of SAFEs. Yeah.
Yeah. I mean, I think it's, with the market conditions right now, I think you're seeing it's easier for the investor to come back and say, no, let's do a convertible note. Because there is a lot of uncertainty in terms of when might a company raise their next round? What happens if it gets extended way out and I want some recourse as an investor? And it's a different environment where the investors probably have a little bit more leverage in this market than they did, a year and a half ago.
Yeah, I think that's right. And I think one thing to add to this, Jeff, is, and I can touch on it or you can, I know you've done this a lot in your own work, is when a current convertible note hits that maturity date, but maybe it's not going to convert yet. I would say this is one of the reasons that SAFEs have been adopted too, is that it's typically, the convertible typically just gets extended on similar terms, right? It's rarely called in because as debt, the maturity date, because there's typically not that many tangible assets, especially, for these tech companies, these tech investment opportunities, right?
And I think that's where investors get comfortable. They're saying, okay, this is kind of going to zero, or it's going to succeed, right? Yeah. And so if this is a zero, I'm taking a big risk here, and it's a zero. Where I think as a founder, you need to be at least cognizant of this is that your investor could call your note at that 12-month mark or whatever they set that maturity date at. They could shut you down more or less. Now, in most instances, that's not in their best interest because they want you to keep going, and there's at least some hope that they'll get some of their money back. But they could force you into liquidation. Where that could be an issue is, let's say that you have intellectual property or something of a lot of value in the company, and they force you into a liquidation point where they say, well, we'll just take over the company and we'll take the intellectual property and we'll just take it from here. Thanks for playing. That is a possibility if you can't secure funding to pay them back, if they're demanding it. So just be cognizant of that as a founder. Like Will said, most instances, there's not a ton of value. If you're having trouble raising as an investor, I'm probably going to say, well, keep going and let's extend the terms. And maybe I might negotiate for some additional equity for hanging out there a little bit longer.
Yep. Yeah. Really interesting point. And that, like we said, that seems to have driven a lot of the adoption of SAFEs. It's it's all going to zero anyway, or it's all going to a lot anyway. The debt's really not going to do much when you call it in. So I just guess last question out of personal curiosity, Jeff, would you say that companies, I know you said IP, but companies with more tangible assets at the early stage would typically do more convertible note versus SAFE?
Probably. Yeah, I think, just from an and again, it depends on your investor. If the investors are, they're doing a lot of SaaS companies and they're used to SAFEs, it's kind of that mentality. If the investor's doing hardware and stuff like that, they're probably a little bit more interested in being protected through collateral and things like that. So you might see more, a more propensity to do a convertible note.
Yeah, totally. Yeah, so there's one takeaway from the slide. It's safe, simple agreement for future equity that is not debt. Convertible notes are debt, but the two mechanics that Jeff, you were hitting on here are that they both have val cap or discount rate. So I think one thing to highlight quickly on this, I know Jeff had talked about kind of the val cap and the discount rate and kind of those two levers and mechanics and what they're used for. I will say one thing to add on this, and then we can kind of do another overview on them, because they're definitely a little complicated and at times hard to understand. So I think it's important to get a good grasp on these two mechanics because they do make a really big difference as it pertains to company or founder dilution and how much the investor gets in the company. But one thing, because I know we were just talking about market dynamics that we've seen here at Carta, and just anecdotally, I've heard it too from a lot of the kind of venture capital lawyers I work with, is that we've been seeing a lot more SAFE or convertible note rounds during the downturn versus price financing rounds, because there's an early stage company who's kind of looking at the current market and saying, hey, if we don't have to get a formal valuation of this company right now, that's not as attractive as maybe it would be if we did a preferred stock financing with the formal valuation on the company, we could punt this valuation out a little bit with that valuation cap mechanic. So we're seeing a lot more companies who would normally be doing seed financing rounds, not categorically, but we see it, I would say, more often or more than we definitely did before. You'll see them doing bigger SAFEs or convertibles. So we're seeing some bigger SAFEs and convertible rounds than we used to see that we assume probably would have been seed rounds before, because people want to get that valuation out into the future a bit so they have a better market to get a priced valuation on.
Yep.
Awesome. Anything to add on that, Jeff?
Just talking about the valuation cap real quick. I know sometimes founders will say, hey, we're just doing a discount rate. A 20% discount on a SAFE or a convertible note is pretty standard out there. From an investor standpoint, I'll just explain why I don't like that and why I've only done a couple of deals where it's had a discount rate only and no valuation cap. The only reason I do that as an investor is if I'm really confident that the company is going to raise their price round in the next 6 months, let's say, or if it's the only way I can get in. It's like a deal that I want to get into, and that's the only way I can get in. But other than that, the reason for the valuation cap as an investor is that, you could potentially do a SAFE agreement with a founder, and let's say that they go 5 years before they raise. Like, you give them enough capital and then they start hitting revenue and they're like, hey, we don't need to raise anymore. Now I'm going to be stuck over that 5-year period where my investment doesn't convert. So there's never that priced round. And so I'm kind of hanging myself out there. And then by the time that they do raise a price round, or maybe they sell the company's gone up so much in value that the risk that I took early on really isn't commensurate with a 20% return. So I end up getting really disappointed on a 20% return that the company is now worth 10 million when I invested when I thought it was worth 1 million, or maybe it's worth 100 million and I invested when I thought it was like worth 5 million. I'm not participating in any of that upside. So that's why you're going to see most investors are going to require a valuation cap. So just be cognizant of that. And I think look at it from the investor's angle as well.
Mm-hmm. Yeah, good point. And the next slide, and I'll share it in a little bit, shows how rarely you see uncapped SAFEs now. just because you got the investors investing money at an early stage. It's a risky investment, to do that early stage, and there's going to be expected returns if the company does well. JJ asked a really good question here that we can touch on, which is, can you raise multiple SAFEs before a priced round? So really good question. The answer to that is yes, for sure. You definitely can. You can have a mix and match of SAFEs or convertible notes, and they'll all be converting onto the cap table with their own terms. And so that's actually one of the reasons why a lot of the times those priced valuation calculations when you create that pro forma cap table, which is your cap table post financing infusion, gets really complicated because there's different valuation caps sometimes for each of these SAFEs. There's different discounts, and so you have to do an individual calculation, which can actually cause a SAFE and an investor to convert onto the cap table at an actual different share price than what the rest of the round is participating at. And that creates something called a shadow share class that gets created, which is the share class that's at the same terms as the other shares, as the other investors in the round, but it's converting at a different price because of the valuation cap. So you oftentimes see these, they'll say like a seed financing round nowadays, where you have a founder who has 5 to 10 SAFEs outstanding on the cap table, and then each of them has a different valuation cap or a different discount. One's got a $3 million cap, one of them's got a $10 million cap, and then at a priced financing round, they all have to convert on their own terms into the financing round. So yes, really good question. We see multiple SAFEs often. Jeff, I guess just kind of as a angel investor data point from you, what percentage of companies, just kind of off the top of your head, who raise a priced financing round, would you say have multiple SAFEs or convertible notes?
I would say most. You see a lot of that. The danger you have as a founder in that scenario, and as an investor as well, is when you start stacking SAFEs on top of each other, you need a tool like Carta or something to help you keep track of what's going to happen when you do convert. Because a lot of founders, they make the mistake of not running those scenarios and not staying on top of it. And they're thinking, oh, everybody just keep giving us more money. And, okay, we'll do a $3 million valuation cap and we'll just keep getting more and more money in. Well, at some point, those are going to convert. And a lot of founders, when they go to raise their seed round or their Series A, priced round, all those notes convert and they get surprised. It's kind of this shock of, wait a second, how did we end up giving away half our company here? Because they haven't stayed on top.
Oh, Jeff, I think we lost you.
Top of how those notes are going to.
Jeff, you there? And Jason, can you hear me okay?
Yeah, I can hear you. Yeah, we lost Jeff.
Okay, cool. I think we lost Jeff for a second there. Jeff's making a really good point about the SAFEs and how kind of complicated that conversion can be. And I was actually just sharing something in the chat here. I just shared this free modeling tool that Carta has. I was going to bring it up later, but it's really important. It's a free modeling tool. I think Carta just basically put your email in when you go in there. But basically what you can do is you can load up into that modeling tool your ownership. You'll fill out the fully diluted amount of shares, and then the options remaining in the available option pool. And then you'll add in SAFEs and convertible notes. And it gives you a pretty directional, but still pretty accurate read on what these SAFEs and notes will convert into after a priced financing round. So you also set the terms for your priced financing round. And just little Carta plug on this too, by the way. We did just build a really cool, it's totally free. There's a free plan if any early stage companies want to do it. Not pushing or anything like that, but there's a cool tool. It's called the Pro Forma modeling tool. Carta just made it with a lot of our law firm partners, where you can actually build out your full legal pro forma in Carta. And it's more robust than that free tool I gave you. The tool is also free, the one in Carta, but it's a real cool way to be able to go build out your financing round, your pro forma cap table for after your financing. And you can just do that, and it does all the conversions and complications with convertibles and notes, just down to a T in app. So it's a pretty technical tool, but I'll send a link at the end of this to kind of share a little bit more on that front. Jeff, you're back.
I'm back. Sorry about that. I don't know what happened, but I got kicked off.
Well, I'm still seeing you have a little low internet bar there. Oh, there you go. I think you're back. Maybe it was just
Okay,
like
hopefully.
a spike in coverage. Well, Jeff, you were touching on a very important subject, which is being able to keep track of all that. So I just sent the link to the Carta modeler. If we get to it a little later, I'll show kind of what that little activity is, or we'll share the deck after to share what the activity is for modeling this out. That's actually kind of the last thing we do in this session typically, is we show people some data, tell people to plug everything into this modeling tool, and then just get a gauge. If you have any SAFEs or notes on the cap table, what does it look like? Jeff, anything else to add on this before we jump into a little bit of the market data?
I don't think so. I think that market data is really valuable, again, for founders to know. And so just jumping into that, I think will be super, super helpful.
There it is. Yeah. And I think this just reinforces everything that we were saying a little bit earlier, which is that you'll rarely see, and you can see down here, here's the majority of SAFEs coming with price caps. You really don't see a lot of SAFEs that don't have a valuation cap, right? So valuation cap, you can see there's a lot with no discount here, right? So the valuation cap seems to be more of the market standard even than a discount, right? Because you can see a lot of SAFEs here that do not have a discount, right? But the valuation cap is the ultimate protector of investor dilution, right? And so, like, for example, I'll just say it again because I think it's really important. Jeff, I know you shared it a bit earlier, but if you have a company and there's an investor that has a no valuation cap, and they give you $300,000 when you're a one-person team, right? And then you go raise around at $100 million. That investor is converting that, say, $300,000 on such a big denominator. It's such a low percentage in the company when they bet on you and you're one person, right? And so, like, like Jeff said, you got to look at the investor perspective. Now, say versus them having like a $3 million cap, right? Which is you see a lot of caps that are on $3 million for early stage companies. And then say you still go raise $100 million. That's actually probably not that advisable for the founder to do, because then that investor has 300,000 over $3 million as their percentage ownership in the company, right? So there's really big differences in that. And so I think there's one piece of it, which is look at it from the investor perspective, which is what Jeff was saying. And hey, there's got to be a valuation cap so they can get some meaningful equity in the company. I think the other point of it too is, as a founder, it's important to know that typically market standard is, and like we said earlier, definitely not legal advice. Talk to your lawyer about this and what it makes sense. You typically see companies raising their first priced round, meaning those SAFEs convert when they reach that valuation cap point, right? So, Jeff, I bet you've anecdotally seen this a lot, where someone's got a $10 million cap. You're just causing more founder dilution if you raise around way over $10 million, right? So if you raise around that, around 10 million, that's typically what you see, versus if you have a $5 million valuation cap and you raise it $50 million, the investor will be happy, but maybe not even, because it's going to be rough for investors in the future to look at that and say, wait, why does this one investor so much in the company, right? So it's actually kind of both bad for both sides if the investor gets way too much out of it. So that's just kind of a quick soapbox moment on why you do that as a founder. Jeff, anything to add on that? I think I did want to just quickly hit on this because I realized we hadn't covered the difference, but anything else on kind of val caps?
I mean, Will, you make a really good point. I'll just tell you a personal experience where I had an investment out there that was on a SAFE, and the founder realized that they weren't going to raise a price round right away. They came back and said, "Hey, let's kind of true things up." I think you can do that. I think one of the key things is when you're working with investors and you want to keep those relationships strong, then you keep them informed. Just be open and transparent with your investors, and let them know where you're at. That's the best thing you can do as a founder, is just keep those lines of communication open, because ultimately, if you treat your investors bad and poorly, it's going to impact your ability to raise capital down the road, because the investor community can be a pretty small world.
Mm-hmm.
So keep that in mind. And then on the flip side is those investors that you're working with early on may end up, investing later on as well.
Yeah.
And so, treat your investors well, and just monitor that throughout the life cycle of your company.
Totally. I also see, and we can quickly touch on this, a fierce debate about MFN or just education on MFN in the chat over here. So I'm no MFN expert by any means, but I know it's something MFN is typically included in what's called a side letter. And so we didn't really touch on side letters, but we'll talk on these two, pre-money and post-money, in a second. But there's a side letter to a SAFE or a convertible says, hey, there's this SAFE that's in place, and then there's individual investor terms that we can change in this side letter or add in this side letter. And MFN, the most favored nations clause, Edwin, thank you for putting the definition there. How I've understood it is it just basically gives the investor who has MFN rights the rights to, or it gives them the best rights of every financing round going forward. And so it's a pretty advantageous right for the investor. From how I've read into it, I've seen companies raise price rounds on MFN. I've seen it go a bunch of different ways, right? For example, MFN is kind of akin to something called pro rata or participation rights. I think MFN is kind of like a form of that. And a lot of times you'll see people like in way later rounds sometimes waiving those rights, right? So it doesn't mean this investor does this all the time, because if they get the rights, it usually means they have to fork up more money to keep their ownership percentage or have the best terms. So just a bit on that context on what I've seen is, but yeah, that's typically what you see in what's called a side letter. Anything else to add on the MFN, Jeff? I know it's a pretty
I think Edwin actually had some good comments. I was just reading through that. And Edwin, thank you for your comments there. If you saw a SAFE, for example, or a convertible note that didn't have a valuation cap, you might see an MFN clause in there that says, hey, if there's other convertible note holders or other SAFE holders, then it kind of protects you to at least get what they're getting. So if they've got a valuation cap in there, in fact, it's probably even better, because you might have, one of the SAFE holders that has a $3 million valuation cap and some of the others have a $6 million valuation cap. That MFN is going to kick in if they raise, and you get to benefit from that. So just be aware of what that means. And again, have a good startup attorney. They're going to help you navigate through all that type of stuff.
Yeah, you don't have to learn all of this on your own. There's already people in the market. Like, you're busy enough starting and creating your own company, right? That's the whole point of this. That's the whole point of this talk, and the software tools and products that Jeff and I work with. Is the idea is to streamline your product development and business development, and for hopefully other tools to be able to help take care of the rest. And of course, startup attorneys are an absolutely critical piece of that. Quickly, just want to share the difference between, we've been talking about SAFE, like all SAFEs are the same thing with their valuation cap and their discount. There's a slight nuance in most SAFEs where there's two different types of SAFEs. So when we talked about SAFEs at the beginning being like punting the valuation out and saying you're going to get equity later in the company, what we're meaning is that equity, either that, say, $300,000 of cash you got from this SAFE, and then the investor gets the SAFE agreement and it will convert into equity in the future, they're going to convert into that, right? Well, the question is, how do they convert onto it? And you all have probably been familiarized at some point with a pre-money and a post-money valuation for a priced financing round. The pre-money valuation is what the investors set for company value. The post-money valuation is what the investors set plus the amount of money that you got. It's pretty straightforward. A lot of times there's two different ways that SAFEs can convert onto the cap table. So there's the pre-money, which means that say $300,000 is converting on that lower valuation, versus the post-money is where the SAFE or that money is converting on the full round, including what the investors valued you at plus the money you got. That's the main difference between the two. Just a quick kind of, there's a couple other technicalities with it where the post-money sets a fixed ownership percentage for the investor when they convert into that round, versus pre-money is a lot harder to calculate because without really going into it, each additional pre-money investor dilutes the next one. And so investors will be diluted by other convertibles. Pre-money is considered more founder-friendly. If there's any takeaway that you have from these, it's one, pre-money is typically considered more founder-friendly. Post-money is more clear for the ownership that you'll know you're giving to investors. It's considered more investor-friendly, but for both the reason of investors typically control the convertible market a little bit better and are a little bit more, have more leverage on it. And it's really clear for ownership. The post-money safes, you can see this top right stat, about 71% of safes do convert in the post-money. Y Combinator popularized the post-money safe. Carta has her own safe template with pre and post-money, but you really see a lot more post-money in the market. Jeff, any other color to add on that?
I'll just say, I think, the post-money safe is probably, it's become kind of the standard and the more common. Investors will typically, push that. And it's kind of a protection again from, for investors if you started to go out and stack a bunch of safes. And so it gives them the ability to say, no, we know, even if you go out and raise a whole bunch of new safes, we still know what our end result's going to be in terms of percentage ownership and all that. So again, a lot of this is going to be driven by your investors. And if you go in and say, well, no, we're going to do this on a pre-money safe instead of a post-money, they'll probably just adjust, some of the investment terms to make it still fit what they are proposing.
Jeff, here's a question I actually don't know the answer to. Would love to hear from you. If there's a company you're investing in, and it's likely, because we talked about stacking safes and having a bunch of convertibles from before, and it's a company where you're pretty confident the amount of money that you're going to give them will get them through to their priced financing round. Say there's investor interest in the priced financing round down the road. Are you more likely to give them or to allow a pre-money safe than if you know there's not going to be a lot more convertibles coming to dilute that pre-money safe? Would you be more willing to give those terms? Do you think that's a mechanic that would influence that?
Again, it's kind of a protection. If things don't go as planned and you start and they decided, let's say economic conditions changed and all of a sudden they were going to raise 6 months from now and they decided instead do a safe or another convertible note round, then you're like, oh, great. Now I should have done my post-money safe. But if you only have one round of safes, it doesn't matter. So if you're not stacking safes on top of each other, then it doesn't matter to me as an investor if it's pre-money or post-money.
Yep, makes sense. Thanks. All right, so we went over the majority of safes come with price caps. We talked about that dynamic. And I wanted to share here, because we haven't touched too much on priced financing rounds. I know a lot of the folks in this audience are kind of more early stage founders. So we've definitely skewed it more towards the convertibles and safes. But just heads up, there's some cool Carta data on fundraising. And you can see kind of for the seed round data, you can see here's just the convertibles. You can see the convertibles versus priced round percentage for seed rounds. Sometimes you'll see seed financing rounds done with safes or convertible notes, but you can see it's about 90-10 the other way. Additionally, you can see for some other seed round data, you can see kind of the priced round for seed rounds, the median, the mean, the average post-money valuation. If you actually get into the Carta free account, you can filter it by industry and such, but I wanted to share just a little bit of data so you have just kind of some indicator on what you see for a seed, a first priced round for a lot of companies. You can see about 20% percentage ownership sold is around the median. And then you can see the equity pool. So that option pool that you create, typically it's created during your first priced financing round. It allows you to issue out options to employees for equity for advisors. It really allows you to take that money that you're getting from investors and infusing it into the talent for your company. You can see that's around 12 to 14% for that, for the mean median for a seed financing round. And that's usually meaning the creation of it. So it's used typically like 0 before that. And it allows you to issue out options to employees. And then the Series A financing data, you can see, of course, you have higher valuations. Still percentage ownership is about 20%. And then you can see typically there's either an increase in the percentage pool at the close to allow for more talent to come on and invest more in the human capital of the company.
Awesome.
Jeff, anything to add on this data? Any other context?
No, this is super helpful data. I refer people to this all the time when they're asking about valuation and things like that. Just some good benchmark data is so helpful as you're going out to raise capital. I did want to do a time check here. We've got less than 5 minutes left.
Yeah.
We probably ought to wrap things up if we've got any questions. I know we've been answering some of the questions as we've gone. I also wanted to make sure that the listeners knew that through Prepare for VC, you've got a special offer on Carta. So some of the tools that we were talking about is, just if you need some help in managing your cap table and you're preparing for a financing round, go use it. Make sure you're using Carta. One, it's going to help increase the confidence in your investors when they see you on a platform like that. And so, I mean, take advantage of that. I think I don't know what the discount is, but is it like 20% or something? You get a discount.
20%. Yeah. Thanks for the shout, Jeff. I think I'll put this in the chat here. If you decide to sign up, there's a free plan where if your company has fewer than 25 stakeholders, less than $1 million raised, and you don't need that 409A valuation yet, you can get onto Carta for free. That's the sign up link for Prepare for VC. And if you sign up through that, you'll get a 20% discount when you go to a paid plan, or if you go straight to a paid plan, which most of the paid plans just include those 409As. We do the most 409A work. It's a common reason why people get on Carta. You get the 20% discount and waived implementation fees right away. So that's the Carta plug, and I will shoot it right back at Jeff. Forecastr also has an offering here through Prepare for VC, and we've done a lot of great partnership work with Forecastr, and they're building a really cool adjacent product. I think you all just went live on Product Hunt. I saw some news about this, Jeff, recently. We'll kick it over to you for more context.
Yeah, and Jason was actually a great proponent for us there. Really appreciate that. But we've got a 25% first year discount on Forecastr. Where that ties in is if you're preparing for your financing round, your investors are probably going to want to go through your financial model, and we help companies build out their financial models. It will help you figure out how much you need to raise, how that's going to be used, things that investors are going to dive into. It's going to help you know your numbers as you head into your financing round. So hopefully that's helpful for you guys as well.
Awesome. Well, Jason, thank you so much for having us on. If there are any other questions, I know we have just a few minutes here. Otherwise, we can also wrap and give everybody 3 minutes back.
Yeah, no, I think this was great. And so for everyone that joined today, this will actually turn into an on-demand recording to go back, and the same link you used to join today, you can go back and rewatch and re-explore the session. And then we can also send out a follow-up email kind of recapping everything to all the attendees and everyone that signed up as well, with some of these links and, a link to the presentation again as well. But yeah, this was great, and really enjoyed all the interaction in the chat, and, the way you guys walked through all the examples and made some complex complex applications understandable for everyone. So yeah, really appreciate that. And excited to continue these event series and other opportunities. So yeah, we'll let me see where I put this. Yeah, I put it at the beginning of our chat, but this is next week. We're going to be having our Startup Spring Series in person surrounding the TechCrunch early stage conference in Boston, for anybody coming out to that. And we're going to have our hybrid demo day event for our cohort on that Wednesday as well. So yeah, all the startups we've been working with for the last 12 weeks of our program, we're going to have the opportunity to pitch and share what they've been working on with the community and ecosystem. So yeah, I would love to see anybody out there. And if there's anything else we can help connect you with or help with each of your startups, feel free to reach out and let us know how we can support.
Jason,
Awesome.
thanks so much. Yeah, love the community you've built and really appreciate you including Will and myself as part of the community here.
Thanks for being a part of it.
Special shout out to those in the chat. I think we have Edwin, Robert, Vpool. There's a couple folks who are super active, sharing a lot of knowledge about these complicated terms. So thanks for all participating. Yeah, super good. Thanks for all the engagement. Jason, thanks for having us on as always. Jeff, great to do this with you again.
Yeah, always good to see you. Thanks.
Of course. Thanks again.
All right. Have a good rest of your week. See you, everybody.
See you guys.
Too.